Managing finances and increasing profitability. This is the financial planning and financial management of an SE course designed to help you on the journey of social entrepreneurship. In this course, we illustrate the importance of financial information and forecasting. Financial information is key to the success of any business. It provides entrepreneurs with the evidence to support their decisions and helps to justify those decisions when presenting them to other people. You will have the opportunity to explore the importance of financial forecasting. Through activities, you have plenty of opportunity to define and work on your business plan, as well as helping others. By the end of this course, you'll be able to discuss why planning and forecasting are key skills within any successful business. Evaluate the entrepreneur's business challenge. How can a social enterprise make its business more profitable? Identify business finances in a business plan. What topics will you cover? The importance of financial information, an introduction to key financial information, tools of the financial management, why forecasting and planning is so important. Forecasting and planning are key skills which any entrepreneur should develop. To run a successful social enterprise, you need to understand, create, and interpret financial information. Think about the following questions. What is included in financial planning? There's initial or startup costs, pricing strategy, break-even analysis, and financial forecasting. Why is it important? Do we have or are we likely to be able to obtain the necessary seed capital? Considering the real price according to the competition and to the available information and the potential segment, can we break through the break-even point? The more accurate the market research is, the more information we can obtain for the financial plan. What are the startup costs? The definition of the startup cost is the investment needed before starting or expanding a social enterprise. Estimate the length of the period. Then it should be relatively simple to calculate the costs involved. It gives more formality to the process and in some cases more weight internally. It's important to be as specific as possible. Details add up. Do your research. Here you can see the typical startup costs. Facilities, equipment, and all the materials that you need for the start. Fill this table with all the information that you have. These are still the startup costs, the different services and fees you need, and all the other costs. Let's sum them up. Here are the key questions after you finish the previous table. How much money do you need to raise? Where will you get the capital to cover startup costs? Does it seem likely that you will be able to raise the necessary capital? The next topic is the pricing. The price should allow the enterprise to function. Normally, customers focus more on product satisfaction than on the price. Don't be afraid to charge a good price. This can always be negotiated down if necessary. Analyze ahead of time who's going to pay or who's going to receive the product or service. This is the target market. And how much they value it. You can always take advantage of offering different prices for different customers. Identify the unit price of your products and services. Identify the unit price of your products and/or services. What aspects have you taken into consideration? What are the cost plus and the value-based pricing? There are two basic methods of pricing your products and services, cost plus and value-based pricing. The best choice depends on your type of business. For cost plus pricing, this takes the cost of producing your product or service and adds an amount that you need to make a profit. This is usually expressed as a percentage of the cost. For value-based pricing, this focuses on the price you believe customers are willing to pay based on the benefits your business offers them. How to build a pricing strategy. There are two basic methods of pricing your products and services. It is generally more suited to businesses that deal with large volumes or which operate in markets dominated by competition on price. But cost plus pricing ignores your image and market positioning and hidden costs are easily forgotten, so your true profit per sale is often lower than you realize. Value-based pricing. This focuses on the price you believe customers are willing to pay based on the benefits your business offers them. Value-based pricing depends on the strength of the benefits you can prove you offer to your customers. The next step is the break-even analysis. What is the necessary sales level in terms of product or services to cover my expenses? The most important factors are the unit time of the analysis. Define the sales unit, define the price, and calculate the different types of expenses. Your unit for the break-even analysis should reflect the way you interpret the social enterprise. The period of analysis should be consistent with the type of product or service being evaluated. Examples of units are the number of the product, the hours for a consulting service, the portion, for example, in catering, the subscribers for publishing, or the participant if we're talking about education, the night, for example, in terms of accommodation. And then you have to divide your fixed cost with the difference of the price and the variable cost of your unit. Define the fixed and the variable costs. Fixed costs. These are all operating costs that will exist once the enterprise is constituted, which can't be avoided and which are independent of the amount of sales being generated. For example, wages, rent, utilities, and telephone. Variable costs are costs that are related directly to the product or service being provided. They only exist once a product is generated or a service is provided. For example, trainers contracted for specific projects or direct materials. Let's calculate the break-even point of your social enterprise. This is how it looks like when you have more than one product in your enterprise. How do you interpret the results from the break-even analysis? Do they seem realistic? Do they seem attainable for your organization? Sales potential as well as production capacity. Evaluate them under different contexts. Have simulations under different prices and cost reduction. This is the key point in the analysis. What are the financial projections? Evaluation of sales, costs, and prices. What could be your objectives? Have an idea by when you will reach your goals. Identify sources of risk, operational or financial, for example. It requires solid market research information in order to determine the starting point and in order to estimate the rate of growth. How do you know how much money you can make? The level of revenue is determined based on sales. Sales projections are produced based on market analysis. Don't even look at the break-even point. You can start your financial projections based on the following. Price. How much can you charge for one unit of your product or service? Sales. How many customers will purchase the product or service? How much will you be able to sell when you first open? Trends. How do you expect your sales to change over time? It's important to consider multiple scenarios. A best case, a realistic case, and a worst case. Be conservative. Generally, the worst case is realistic. What is the revenue and what are the expenses? The total revenue is the total amount of a company's sales and other sources of income. The expenses are business expenses and the cost of the company incurs each month in order to operate, including rent, utilities, legal costs, salaries, contractor pay, and marketing and advertising costs. To remain financially solid, businesses are often encouraged to keep expenses as low as possible. Startup costs. These are expenses incurred during the process of creating a new business. Operating costs are expenses associated with the maintenance and administration of a business on a day-to-day basis. The operating cost is equal to the cost of goods sold plus the operating expenses. Let's make revenue projections assumptions. What is your price per unit? How many customers will you have per day or per month? How much will you sell when you start your business? How much will you sell in 1 year's time? Make different scenarios and then fill in the other table as well, month by month. And let's see how much it will cost. Expenses can usually be very precisely predicted if you had accurate market research. For the financial analysis and for financial forecasting, we use 3 different types of expenses: initial cost, fixed costs, and variable costs. The fixed costs are not related to sales volume. To design our fixed costs, note the price changing, inflation, raising of overheads, for example, change in employment regulations, and the increasing wage expenditure. Fixed costs are based on realistic data based either on our experiences or our research. Variable costs vary proportionately depending on our sales. Use the specific direct cost per sales unit. For the forecast, multiply it by the monthly forecasted number of units sold. And then fill in the table. What is the net income? Net income is a company's total earnings or profit. Net income is calculated by taking revenues and subtracting the costs of doing business, such as depreciation, interest, taxes, and other expenses. To calculate net income for a business, start with the company's total revenue. From this figure, subtract the business expenses, operating costs, and liabilities to calculate the business earnings before tax. Deduct tax from this amount to find the business's net income. This number appears on a company's income statement and is an important measure of how profitable the company is over a period of time. The bottom line. This is the total amount a business has earned or lost at the end of the month. The bottom line is the last financial figure on a ledger. The term can also be used in the context of a business's earnings, either increasing or decreasing. And now you can fill in the profit projections. And don't forget the following. The biggest challenge is projecting sales. Don't fit sales to your break-even. Look at different scenarios. Try using different units, different assumptions. Compare these with other ways of projecting revenue, like industry standards. Are you totally off base? Small changes can have a profound impact. Production capacity does not equal sales volume. Why do we need financial systems? A well-functioning financial system provides data on the following: sales planning and registering, income planning and registering, expenditure planning and registering, assets registering, liabilities registering, cash and deposit registering. How else can we use the financial systems? We can use them to manage cash flow and financial planning. Remember, financial planning is not the same as accounting. For software, internal controls, and allows us to check profitability, cost-cutting opportunities, and how to approach financial difficulties. Payment schemes, for example, keeping track of web payments or partial payments, and the separation of different projects. Risks. We can discuss shortcomings of our current system and short and long-term plan to overcome them. What is cash flow management? The main goal is to avoid lack of liquidity by controlling our payments and the payments of our customers. What possibilities do we have? Discounts to motivate our customers to pay earlier, advance, immediate reminder on overdue invoices to our customers, and in case of bad payers, accepting only cash. Utilize maximally the payment deadlines of our suppliers. Preferring suppliers with flexible paying conditions. Loan and factoring. Finally, there is a guideline for setting up a financial system. It has to be trackable, searchable, have double checks, be result oriented, have timesheets. It should be clear and in harmony with the accounting system.